Industrial buildings have increased in value almost everywhere in the United States by anywhere between 50 and 75%. That's an incredible increase because historically, these buildings go up 3% a year in value, and they've been going up something like 12 and 15% a year in value.
Hey folks, welcome back to the High Voltage Business Builders podcast. All right, if you're interested and you're an e-com person, if you're interested in understanding the logistics, freight management of 3PL or operations that support the back end of businesses and brands moving products, we're going to talk about some of that today. We're going to talk about what it means in the coming future to businesses in terms of the movement and logistics of product is most likely going to change here or be adapted, as it always is. In the years I've done this, in 17 years, many things have changed. Many people have forecasted stuff that did not come true. But as you get more experience, and as I talk to this gentleman today, you're going to pay attention to his experience in this space, because I think it's going to be very important for those of you who are in the branded space, e-commerce, and in the physical products world to understand what's going to be happening in the coming 12 to 24 months. Because I think that's going to be an important change in the economics of our country. So without further ado, Joel, thanks for coming on the call, brother.
Hey, great to see you, Neil.
Break into that for me a little bit, and let's understand where you live in your world right now, and what are you doing?
Sure. So I am in the industrial real estate investment business. I am an industrial real estate syndicator, which means I've got about 200 limited partners that invest with me in warehouse buildings. So a lot of people are familiar with the multifamily business, and a lot of people are familiar with retail and office buildings, which, by the way, office buildings, as an aside, are suffering terribly right now because hybrid work and people working from home. But industrial is different. You can't work from home if you make a product or if you distribute a product. You have to physically be there to actually handle the product. So industrial's been booming. It's a crazy situation. Since 2019, so that's 5 years, industrial buildings have increased in value almost everywhere in the United States and around the world by anywhere between 50 and 75%. That's an incredible increase because historically, these buildings go up 3% a year in value, and they've been going up something like 12 and 15% a year in value, which is a shock to the system, huh?
But it is matching the economic growth of most of the online e-commerce systems. In the last year, Amazon, for example, had a 13% growth. So that really matches the same growth of the physical product world in many ways. So
it does. And in fact, it's even better for industrial than it is for the manufacturers and distributors, because we lock in leases on a long-term basis. So we have steady income from those companies. And because they make a profit, we just make a return, but our return is subject to leases coming up and being renewed. So when a lease comes up, let's say this year, for example, we had 3 leases come up. One of them was with the U.S. Postal Service, biggest delivery company in the country, just happened to be primarily supported by the federal government. Their rent in our building went up from what it was in 2019 through this year, 5 years, $6 a square foot, went up to $19 a square foot.
that's a big jump.
Triple. The rent tripled. And they got all pissed off because I said to them, hey, your rent's going to go up. And they said, well, we're the government. We just can't accept what you say. We need you to get an appraisal.
Wait, the government said that to you?
Yes.
Is there no hypocrisy in that? Or even irony?
I could go on and on about the U.S. Postal Service. And I hate having it on, on video that there's anything wrong with them, but there's everything wrong with them. And so I believe in small government, and the U.S. Postal Service believes in being supported by the federal government, even if they run things in a ridiculously incompetent way, which I can assure you they do.
Yes, they do. I've seen it. I've delivered. Just the output of their effort has been terrible where we live. Packages are showing up on the side of the road or hanging on the fences or just not being delivered at all. You're like, good grief. Their last mile delivery is.
It's funny. One of my investors was in town from Utah, and he came in and he said, how about lunch? And you'll take me to see the building where we have that tenant, the U.S. Postal Service. And so we went to lunch in Greektown, which is a beautiful area in downtown Chicago. And luckily, I chose this restaurant because it's 1 minute away from our Postal Service warehouse. I said, let's go.
Yeah.
So we took a ride over there and we walked in the back door. We sort of snuck in because if you don't have an appointment, they don't just let you walk in the back where they have their warehouse. So no, so we snuck in the back door.
Well, they don't just let you walk in.
Yeah. And it's actually where the docks are. So we actually snuck in the door next to the loading docks. And we walked into the building and there are all these bins all over the place. And the investor said, how can they tell the garbage from the mail? The way it's all stacked up in these bins, it looks like there's garbage here and mail over there.
Yeah.
It's the most antiquated system, but they are a gigantic distribution network and we are lucky to have them as a tenant.
Well, yeah. Yeah.
And they pay the rent.
And they pay their $19 a square foot now. So
$19.
happy day.
Yeah.
Was that a cost basis raise that you had agreed on, or was that just normal? I mean, was it normal operation cost, uses cost, power costs? Why the jump?
Well, actually it's just the market rent.
Just market rent had changed that dramatically.
Yeah. In that neighborhood, that's a neighborhood in Chicago where a lot of changes have taken place. It used to be what's called the Fulton Market, still called the Fulton Market, where the meat cutters supplied the meat to all the restaurants. And just like in other big cities, they have an adaptive reuse. So they took this really charming area that was kind of crappy with, if you walk through there years ago, there would be barrels with the heads of pigs and cows and blood in the street.
It sounds brutal.
It was disgusting, but people made a living cutting meat and supplying it. So someone had the brilliant idea of repurposing that whole area. It was really close to downtown and it's got a little sort of a charm to it because the buildings are very old and there's a lot of exposed brick. So the whole area has been rehabbed and now we've got the headquarters of Google there, the headquarters of McDonald's, the headquarters of Mondelez that makes Oreo cookies, law firms, accounting firms, restaurants, little boutique stores.
Brought in a lot of money into the space.
Yeah. So what's happened is that area has gone up in value because of where it is. And our little post office building, it's 28,000 square feet, is just on the outskirts of the Fulton Market. So because the Fulton Market increased in value tenfold, our little area that's just adjacent to it only increased threefold.
Now, was that part of your syndication that you put together in order to acquire that building?
Yeah. I've got 100 investors in that deal. Everybody put in, let's say $50,000 way back when, 100 people. So we were into it for $5 million. And I'd say possibly today it's worth $15 million. We got lucky. It's luck. It's pure luck. The Fulton Market went from being a disgusting place of meat and cow heads to being the most charming area in the city.
But I mean, the longer you're in business, those kinds of things happen. We have a little bit of luck in business, right? I mean, it's probably not the usual deal, but every once in a while, one of those deals pops off and it's like, hey, look, the 5 million became a 15 million in 15 years. That was a pretty good deal because of acquisitions, situations, economics, and just being time and market with the business. What's your average deal look like, in that time frame? What's a normal deal look like?
Most of the deals, as I mentioned before, they've gone up 50% at least. So I've been doing this for 40 years. So a building that I bought approximately 40 years ago with a group of 15 investors that we still own currently is worth roughly double and a half what we paid for it. So maybe we were in for $1 million and now it's worth $2.5 million. Very different because over a 40-year period going up 150%, that's only about 3 or 4% a year. So it's very different than what happened just west of the Fulton Market post office building. That's typical. The average industrial building goes up about 3% a year, except when there's hugely accelerated growth like there has been.
Well, yeah, I would assume if like in our world, due to the amount of movement of logistics and change in people's locations from 2020 forward, it's changed, I bet, quite dramatically for you.
Yeah. There's been so much development of these large warehouse buildings where Amazon is, where Wayfair, what's called third-party logistics. Those are warehouse companies that store products for smaller companies or smaller amounts for big companies. But there's also this niche that we're in, which is the small industrial building niche. And that's a really fascinating one. We have a lot of manufacturers. Manufacturing is doing great right now in the United States.
It's supposedly going to do a whole lot better.
It will do better. It will replace a lot of what's happening overseas. We're going to bring it back, which is called onshoring or reshoring. And so we see that happening already. And so manufacturers are expanding and they're taking a lot of space. I love manufacturing companies. And in Chicago, we've got a lot of food companies because we have really good fresh water in Lake Michigan, and food companies need thousands and thousands of gallons of water, both to make their product and to clean their pots and pans. It's a really great market for food companies. And we have one group that makes protein bars. Yeah, we have another group that's a client, he's a friend and a client, not an investor of ours, but he makes cheesecakes. About $70 million a year's worth of cheesecakes.
Supplier to the Cheesecake Factory, if I make a logical assumption.
No,
Really?
interestingly,
No,
no.
without that,
Yeah.
there's an opportunity.
It's a group called Eli's Cheesecake, and they make beyond cheesecake a lot of other products. They make products for Starbucks. They make products for the airlines. If you fly business class, whatever your dessert is, chances are it came from Eli's Cheesecake.
Okay. No, is it you fit food in Chicago, but it sounds like there's some other verticals you work in as well. And is it across the country, or are you just in the Chicago area?
I'm sticking to Chicago right now. We used to be national, and I'm 65, and I decided that with the age that I'm at, I don't need to be on an airplane flying around every week to go see buildings in other cities. Chicago's got a huge industrial market. We've got 20,000 buildings, and we have about 1.5 billion square feet. That's enough to keep a guy like me busy. That's a lot. That's a real lot.
Is it primarily food in that area then? Do you do other kinds of?
No, it's everything. It's companies that make parts for airplanes, parts for cars, pumps for tractors, everything in the economy that you can think of. Whatever the product is, the parts that go into it are made in an industrial building, period. There's nothing in this country that you can buy that hasn't been through an industrial building, with a few exceptions, like maybe sod for your lawn.
We need to have a deeper conversation. I didn't realize you were in that breadth, because obviously we build physical products. So we're always looking, and have been talking more recently in the coming months due to changes in economies, whether or not it would occur or not, how much more onshoring we can do and should do and want to do in the coming years. And so I think you and I need to have a secondary conversation about which manufacture and what our businesses or clients could use in that production as well. Always need to find and produce more. But I think there's going to be a resurgence. I'm excited about it, getting things more onshore. I think most people misunderstand that somehow they think China is still the biggest, importer of products to the United States, but it isn't, is it?
Well, actually, many of my tenants have stopped working with China. They've been very concerned about the political environment there, and they're making their products in other countries, crazy different countries that you'd never think of, including Vietnam.
Yeah, Vietnam's been big. I've got a friend who just got back from a trip there where he's sourcing a lot of his stuff out of Vietnam, because he can, in Taiwan and South Korea, those are similar areas of production capacity, et cetera, and can make most anything you can get out of China with better quality environments and less people problems. I'll just say that in air quotes.
So they're making a lot more products here, and it's going to keep growing. It's going to be great for industrial real estate. But I have to tell you one thing that's unusual that we do. Are you a fan of Dave Ramsey at all?
I get what he does for the basis. I understood it differently when I was poor, and now I understand it differently as an investor. But I understand he has a place and does a great job with those who are up and coming and thinking about better ways to manage their money, for sure. I don't know him personally, but I know the affect of what he does.
Yeah, I don't know him personally either, but his mantra is, don't borrow yourself into oblivion. Pay cash for things.
Yep, that's great. Get yourself out of debt.
So I hate debt. In 2008, when the economy blew up, I had 50 buildings in the value range of in the hundreds of millions of dollars. And I had 7 banks and I had loans on all 50 properties. And because of the economy cratering during the financial crisis, we had all kinds of problems because banks don't have a sense of humor. They wanted to get paid. And if a tenant moved out of one of our single tenant buildings and it's 100% vacant, it's hard to pay the taxes and the utilities and the mortgage. So I learned a hard lesson, which is in the long term, having debt is good, but it's dangerous.
There's always a risk.
There's always a risk. So I have gone super conservative and I have gone all the way to the edge of the, what I would call the edge of the abyss of risk taking, where I don't take much risk at all anymore. We are now buying our buildings when we syndicate a deal, 100% equity, no debt.
Smart. And that's part of that syndication value. I mean, if you had to maybe bite it off on yourself, that's a different story. Doing it at the beginning, I could see why you probably did leverage that debt to get things off the ground, but there's always a different way, of course. And I'm a huge proponent of getting out of debt anytime, anywhere, any place.
I think it's so important to some people. There is always going to be the folks who love risk.
Well, there's Kiyosaki, right? Who always pushes bragging about how far in debt he is on the way he does it.
Yeah. I think it's gambling. It is.
It's gambling. And some people love that opportunity. In fact, gambling just passed in Missouri. And I'm like, no, come on. It's not the right kind of gambling. There's gambling in business and there's gambling at casinos. So there's levels of gambling, and business is a different gamble altogether. I mean, you and I running our own companies is a gamble. It's still risk.
It is. We have overhead, whether we make money or not.
You still got risk. So we are gambling to some degree.
To some degree we are. I look at it and I say, is it gambling if it's business and it's well thought out and you've got a plan? And the answer is, I don't think so. I think gambling is when you make an impulsive decision to do something that may not be the best idea. And you've seen it time after time when someone has a brain fart and they spend money on something that they think isn't risky. And they find out when they lose all their money that it was very risky.
It simply didn't do the right analysis, the right thought process, maybe a little too much emotion built into it. And then, the realization kicked in and it hurts when that check comes due.
Yeah, I would say impulsivity is the enemy of safety.
And business risk is really different because at the end of the day, the word that comes to me is control. Because while I'm risking in business and putting capital out for expected outcome, which could be inventory buys or marketing buys that expect as a part of, the sales process to turn into sales, I have more control. If I take and gamble that down at a casino, I have like 30% of the control, maybe 20%, which puts all the control in the hands of the person you give the money to. And I think that's the risk level differences in my mind between the two. Does that make sense?
Yeah. And they have unlimited money. You can run out, but they can never run out. They have to
and most everybody in gambling runs out of money. And which is why businesses fail in years 3 through 5.
That's right. It is exactly parallel. It's the parallel undercapitalized businesses are the ones that fail, because if you've got a good idea and you work hard, as long as you have staying power, you can make your business work.
I've seen it time and time. People get going, they get moving, they get out 18, 24 months. Things are starting to move up and like take that growth mode into year 2 and into year 3. And all of a sudden it's like the business is going, we need $500,000 in capital. I need $250,000. I need $1 million. Like if you really want to take this out for the next 24 months, people throw their hands in the air. And I'm like, no, that's it. That was the whole time. That was your big window. That was your big moment in time. Like you're going to be on a podcast in 2 years going, well, remember when, somebody asked you that question, what did you regret in the last 5 years? Then it was like that moment right back here when the business went and I couldn't go with it. And I see that way too often. It's not the getting started. It's not getting things figured out. The growth component. And that's typically years 3, 4, and 5 when growth can meet scale and they simply can't capitalize on it. It's so frustrating.
What's your current focus? What kind of products are you working on right now?
Oh gosh. We just launched a series of bed sheets that's going to hit 7 figures. We're over 2,000, 2,500 a day in sales. That one's growing in the initial test phases. It's a 7-figure business on its way out. And we just launched it about a week ago. We've got 8 different brands. We're in the process of launching from home and kitchen goods, desktop counter appliances, coffee making and espresso equipment. We've got stuff at the home side. Like I said, with sheets, we got bedding. We've got air mattresses. Shoot, dude, anything that's profitable that has that high market demand in the marketplace that is typically $50 to $400 in retail price point, we're in those products.
Are you competing a little bit with the pillow guy?
No, actually, he's going bankrupt. So technically, there's huge market share, and he got kicked off of most of the platforms. So he can't run in some of the platforms at the moment just because of what happened with him politically in the last 3, 5 years. But there's always a huge market share for these. We're talking about people that have, 10, 20, 30 million searches a year for that specific product. It's very in demand, and there's always 2 to 4 players in there. And that's completely room for another third or fourth player in that market. That's one of the ways we evaluate it. But the opportunity cost bar is up here, which means you got to deploy enough capital, like 50, 100,000 in year one to really make it work. And then by the time that growth kicks into year 2 and 3, you're deploying, a quarter million to $500,000 to really see it grow to scale. And that's
Where's it manufactured and where's it distributed from?
we products in the United States, got 2 in the United States manufacturer wise. I want to get more. We got some stuff we're looking at in Mexico. We have with some things in China, but we're already working most of ourselves and our clients away from China at all. We've got stuff in Pakistan, India, Italy. We're looking more into Vietnam right now. But really, I'd like to just consolidate all of that down to the US. It's just some of these products and tooling aren't in the US yet, but I'm very optimistic that in the next 12 months to 24 months, we're going to see a huge resurgence of onshore tooling to meet the product demand for a lot of those. The chipset, like we see that building up fast. I think IBM as well as Dell. And last I heard, what's the chip maker? I just forgot. Intel is moved to Texas and is starting to build large facilities to get onshore chip development out of Taiwan and other locations. So I really see in the next 24 months, a huge resurgence of a lot of things you had to go offshore to get are going to be back in the United States and available in like 2 days and available in 6 weeks on manufacturing, not 3 to 4 months, which is going to change the supply chain greatly. So that's what I see. What do you, I mean, you're close to the ground too at the building level. What are you saying?
I see exactly what you're saying. People are very optimistic that there's going to be manufacturing happening here that is filling holes in communities where there used to be heavy manufacturing and the jobs were lost, and now they're going to bring some back from overseas. But there's still a very important reason to be producing overseas, and that is it's much less expensive in certain countries to make products there and ship them here.
But they forced
Yeah.
us into that. I mean, they did. They really pushed us into that through the 70s and 80s, as you know. And then really in the 90s, the boom came with the internet, which really pushed that amount and quantity of sourcing, which pushed pricing and demand down. Of course, elasticity of supply and demand's economics. But I think the need is great that people with commercial buildings and opportunities for product and manufacturing onshore is only going to double or triple. It's going to be demanded now, I think, as we've seen it in the last week, that people are demanding it.
Yeah, it's especially growing fast in and near Mexico.
The answer to the question earlier is Mexico. They are now the largest
Yeah.
importer into America, bigger than China. I don't think most people realize that. And that isn't just all Chinese manufacturers in Mexico. Many of them are scared. A few of them shut down production plants and stuff in the last month due to threats of incoming potential tariffs. So they kind of panicked a bit and stopped production on a lot of stuff
Yeah, there's a problem in Mexico with manufacturing. I don't know if you're aware of this, but it's the electric grid isn't necessarily
very aware of the electric grid problem. It's almost as bad as ours.
Yeah, get electricity. You can't make
That is right.
We have buildings where we've got, let's say, 400 amps of power with 480 volts, and that's an important statistic when you own a building. Because if someone comes in and they're making products that requires, let's say, 800 amps of power instead of 400, you're reliant on the local electric company to bring in power into your building, and it can take months for them to bring it. So you could be out of business if you add a product and you need to add electricity. But what's worse is if you have a building and there's no electricity from any source coming to the building, because then you can't even add any. And that's one of the problems that Mexico is facing is there's not enough capacity for some of this growth that they're anticipating. It's a gigantic problem.
But it's a gigantic opportunity if Mexico can figure it out. And if Mexico can remove some of their regulations, I know that our EPA influenced them greatly, which is terribly unfortunate because it's their own country. And when they were coming after us for the power grid and taking down nuclear and shutting down certain things and switching us to wind and other technologies that are only temporary in time have to be stored. And then you have all the backlash on solar and whatnot that's coming that also has its issues. But quite frankly, our grid is super old. I mean, I was working in North Carolina on their grid back in the day with IBM and got to go into the room there that ran the switches for that power grid. And it was like going back in time. Like you step into a room, you could smell the old, because the systems that are all just there are all switched based systems running our power grid from like the 60s and 70s. And the guys are just as old because they're the only ones that know how to run it. And I'm like, this is incredible. Like, people think we live in this cool digital society, which a lot of us do. But then you just move off and figure out how you get your power to your cool digital society. And you realize it's running on 1970s technology, which is crazy. So you have to look at the billions of dollars that need to be spent in increasing that. You got to change policies in certain locations like Mexico, et cetera. Would have to change policies, but that's also their opportunity cost, right?
The other problem is the infrastructure for transportation.
Yeah, you got cartels and gangs and all kinds of road problems and logistics, which is traffic. And I mean, if anybody's been to Mexico, you know what I'm talking about.
It costs a lot of money to bring water, sewer, and roads. And most of these communities don't have the money to bring the water and the sewer.
That's correct.
And the roads.
They don't have the incentive or the money. That's right.
It's so hard. Yeah. So
Governments.
it's one of the reasons I like Chicago, because we have a great electric grid. We have plenty of highways, tollways, rail.
Oh yeah, lots of rail through Chicago. Much.
The rail converges in the middle of the country to go from east to west and from south to north. So Chicago is an old city, having been here for in the hundreds of years. The transportation routes are really well established. So every company in the country of any size has to have something here in Chicago, which is why I don't get on airplanes, because I don't need to. If you look up a company, there's a British company called Bunzl, Bunzl, and they make many different kinds of products. They have 170 companies that they own and publicly traded on the London Stock Exchange. And they just happen to have a company here in Chicago that's in one of our buildings that makes safety equipment for the welding industry. How's that for specifics?
That's pretty niche, but also very large. It's a very large niche.
It is. And Bunzl has multiple buildings in Chicago because the labor force here is good. The transportation is good. The water is fresh. So I'm really just very bullish on Chicago in terms of what we have to offer for industrial companies who make products like you do. But there's a lot of downsides. Also, it's a high tax state. There's a lot of debt in this state. There's a lot of debt in Chicago. There's crime in Chicago. Every single positive on the list of positives for each area, whether it's rural or whether it's right here in downtown Chicago, there's a list of positives and a list of negatives. One of my investors says this. He says, Joel, every single thing in the world is like a balance sheet, including your marriage and including your kids and including your house. A balance sheet never has all assets and no liabilities, or all liabilities and no assets. It's a balance sheet. And the bottom line is the net worth. And if the value is greater of the assets than the liabilities, then it's a viable place. So I'm sure you see the same thing. There are places that you could build a building and have a manufacturing plant, but there's no sewer, there's no water. You can't have a sprinkler, which is required because you have to have fire safety. If there's no water to the building, you have to have a water tower that's this gigantic tower, and it doesn't have enough capacity to meet the insurance company requirements. So every place where you could make your products has these pluses and minuses.
Absolutely.
And what we figured out is that, yeah, go ahead.
You're 100% right. It's one thing or another. You got to balance out the human capital component of it as well, which is getting a workforce that can actually manage. Even if you have all the resources available for location, there's always some balance in there that has to be made.
Yeah, it's why companies don't move away from where they're at, because their employee base are trained. These are trained people who know how to work their machines. And if you were to take a company that's sitting in Chicago and move it to Joplin, it would be a giant problem because you'd have to hire all new people and train them.
Or incentivize them enough to move, which I think is what Elon just did when he ditched out of California. He's like, I'm taking my highest paid people, and guess what? We're going to Texas, and you're going to get more stock share if you come. So,
But that only works for really giant companies. Little companies don't get many incentives.
no, you are correct. Yeah, they have to be made. That's right. And Texas gave a lot of incentives for.
Yeah, oh, yeah, because the local politicians like announcements. They like to announce, we just brought in this big company. And the little company, they say, we just brought in this little company. It's like, so? So what?
Yeah, blink. Dropping a little rock in the ocean, right? Yeah. But in the commercial space, let's dig in here just for a second on terms of, I'm going to say this the wrong way, forgive me, but how you make your money with your syndicators and these kinds of deals. So somebody's listening to this and they heard us a minute ago, you're like, okay, $50,000 could return X in an investment. How does that work in the structure of what we're talking about here?
Sure. So we buy based on cash flow coming from a property. So the tenant pays rent. Let's just make up a building. A building might cost $2 million. And my investor group says, okay, if I buy treasury notes, let's say the 10-year treasury, and it's at 4%, what return do I need on an industrial building that's not guaranteed by the US government in order for me to take the risk to invest in an industrial building rather than a treasury note? And the answer is double. So if the federal 10-year treasury note, this is how I look at it, and I think a lot of people do, is 4%. I need to give my investors a yield of 8%. But it needs to also have upside. So it needs to be an investment that if somebody puts in $50,000 into $1 million building, that also in 10 years that the building may be worth, things go well, $2 million. So that's a 10-year hold where you make an extra 10% a year on the upside because you put in 50,000 and you're getting out 100,000 plus your cash flow. The cash flow goes up every year. So if it starts at 8, rents are in today's industrial world because the supply demand favors landlords right now. So they're putting absolutely firm escalations in the rent. Every year it goes up, and it usually goes up about 3% a year. So over a 10-year period, an 8% starting yield turns into an average 9% yield. So if you look at the 9% that you're getting on average in your pocket, we call it mailbox money, and the profit when we sell it, which might be 10% a year, that's 19% average annual return. So my investors are shooting. They're not gambling. They're investing.
I like how you clarified that. They're investing with a bit of gamble on it.
A little gamble. So they're looking for a 10-year, roughly 18% ideal. If Warren Buffett could make 18% a year for 10 years in a row on his investments, he would say, I've done well. If our investors can make 18%, and the way that we play it is we do this no debt situation because the danger is if you have 10 buildings and there's a horrible downturn and you owe money on 10 buildings, you could lose 3. If three buildings are foreclosed on by the lenders, it doesn't matter what your return is on the other 7. You lose basically all of your return. You might get your money back if you lose 3 out of 7, but you might make nothing. So we look at it and say the staying power of having no debt is so important. And then when our manufacturers get in trouble and they call me, and we've got this one company that makes exhibits for children's museums. There's a children's museum in every city in the world. Somebody makes the exhibits. It's actually a company called Red Box Workshop in Chicago on Trip Avenue, which, by the way, they're very creative, and that's the same street that Walt Disney was born on. Yeah, the creative guy. So this company makes these exhibits for children's museums, but there's sometimes a period of time where they don't have a major job. So the woman who owns it called me and said, hey, I'm a little slow. Can you give me a little break on rent? If I had a mortgage to pay, my answer would be, I can't. There's no way. But what I did when she called me and asked that is I said, how about if we give you a 30% break in rent for 6 months? and you pay it back 5% a year with no interest over the next 5 or 6 years. And she said, would you do that? I said, yeah, we can afford to do it. We don't have any debt.
You have control. Yeah.
Yeah. It's really a different model. My partner who, calls me and says, hey, so-and-so in our building has a leaky, window. There's a window leaking, and under their lease, they're responsible for replacing the window. And they asked us at the landlord, would you guys put the window in? Cause I'm only on a 5-year lease and you're going to own the building forever. So I say to my partner, hey, Eric, we can afford to put in a new window. It won't hurt us. And then we have goodwill with the tenant.
And they will stay on.
Theoretically, there's a value to that. So there's a bunch of reasons why we like to do this no debt program, because it makes us feel like we don't have to worry about how to pay for the next thing if a bad event occurs.
Right. Well, so you wouldn't refinance anything or do a cash out like some refos do in year 2 or 3 after you reevaluate the business. So you basically going in and everything is being cash flowed on a percentage of return and IRR over so many, over 12 months on a return.
Exactly. And investors who are looking for like a giant return real fast,
Not your player. Yeah.
are not a good fit. No, we own things long-term. We just keep collecting rent, and the rent theoretically should go up.
But you own the building, so if you ever decided to just portfolio them up or sell them out or let them buy you out of your lease if they want it or whatever, then you have, I'm sure, that option in your clauses to market it, and everybody who buys it gets a piece out, right?
Yeah, but I wouldn't sell it to another investor.
Understood. I mean, yeah. Oh, well, okay. That's, of course, you could do it. Well, I would expect you to sell it back to the tenant or sell it back to the business.
Yeah, we sell to a lot of our tenants. They get really pissed off that they didn't buy it earlier because,
Of course, because when they look at the cost, they're like, hey, how much does this thing cost? If we could have bought this building twice.
right, they call it pissing away rent.
Yeah, but if you're looking at the need for cash flow and operations, it was much easier for them to just pay the 3, 5, 10, 20,000 a month than it was for them to come up with $2 million necessary to capitalize it, CapEx versus OpEx, right?
Right, and it takes, if you buy a building, it takes your cash, your operating cash, and it takes away your credit line, because now you've got all these borrowings, and the bank looks at your balance sheet and they say, well, you've got a little too much debt. We're not going to loan you the money to start making the new product.
Most manufacturers are below sub 10% on net income anyways on their EBITDA, so they don't have that kind of cash flow operations to do large acquisitions.
That's what we see. Yeah, exactly. Yeah.
So they can run it out of cash flow. Where do you do all these deals? Do you have a website or something where people get in contact if they're interested?
Yeah. The company's called Brit Properties, BRIT properties.com. I say you have to be a millionaire to invest with us, because if you don't have a net worth of at least $1 million in addition to your home, you're not accredited. And the regulators, which is the SEC, the Securities and Exchange Commission, believes that people who have $1 million over and above their house are sophisticated. Now, I can tell you that most aren't.
What's sophistication to one person and another person?
Yeah, but the SEC thinks if you're a millionaire, you're sophisticated.
Well, I respect that degree, but I have a lot of friends and acquaintances, as you do, who are high income individuals. And I look at that and go,
I wonder how they did that.
That's all I'm saying.
Yeah. So when people invest with us, 50, 100,000, 250, and people come from all over the country into our deals, because Chicago is the best industrial market in the country. For sure it is.
Yeah. No, bring on the onshoring, man. Faster terms, better products, bringing that money back onshore. I'm all about that. But Joel, man, I appreciate you so much. I threw up the link on here. If you're watching, if you're not and listening, check it out on the Apple show or on YouTube or anywhere else. Leave us a comment, snide remark, feedback, doesn't matter. Help us with big tech. Get the message that's out there so Joel can get his message to the world. Guys, if you are looking for an investment in real estate, you need cash flow, you want cash flow, you're an accredited investor, and you're looking for something, I suggest you check it out. Joel's a good guy. And if you're manufacturing side, we might have some things for you in the future, because I'm going to chat with Joel and see what kind of products he's got, because I want to onshore more products. One way or another, brother, I appreciate you for coming on and having a good word with me today.
Thank you, Neil. Thank you.
All right, everybody, go back, like, comment, share this with somebody who needs to hear this. As always, we appreciate you guys listening and giving reviews and continuing to make this a great podcast for everybody who listens. And always remember, the opportunity begins at the end of your excuses. I'll see you guys on the next call.